We're jumping straight into applied digital today. Everyone is watching the price action, but the real story is the transition from a speculative trade into a mission-critical infrastructure landlord with a $16 billion backlog.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the nuts and bolts of what might be the most fascinating pivot in the market right now, make sure you subscribe and hit the like button so we can keep simplifying the complex for you.
All right, let's set the scene properly because context is everything here. If you were looking at this company, say, back in 2023 or 2024, you probably had a very specific mental image.
Oh, absolutely. You saw applied digital and you thought, Bitcoin miner.
Right, volatile, tied to crypto prices, basically a play on electricity rates.
And to be fair, for a long time, that wasn't an unfair assessment. That was the bucket they lived in. Bitcoin goes up, they go up. Bitcoin crashes, they crash.
Right. But looking at where we are today, it's Wednesday, January 28, 2026. That label feels almost ancient. It's like calling Netflix a DVD mail order service.
Yeah, that's a good way to put it. The company we're looking at now is doing something fundamentally different. They aren't just mining coins anymore. They are building the physical backbone for high-performance computing.
And we hear that word pivot thrown around constantly in the tech world.
Constantly. And usually it's code for our original idea failed, so we're throwing spaghetti at the wall. But this feels different. It feels like they actually caught the wave.
The proof is in the numbers. We just saw their fiscal Q2 2026 earnings. They came out on January 7th, and the numbers were honestly staggering.
Let's get to that headline number. Revenue hit $126.6 million.
Which is up 250% year over year.
250%. That's a massive jump.
It is, but don't just look at the growth rate. Look at the expectation gap. Wall Street, the analysts who build these models, they were only expecting about 86.7 million.
86 million. So this wasn't just a nice little beat.
Not at all. This was a 46% upside surprise.
That's huge. I mean, you see a beat of maybe 5–10% if it's a blowout quarter, but nearly 50%. That tells me the market fundamentally misunderstood how fast this was all coming online.
It validates the entire thesis. The bear case against them has always been about execution. Sure, you have nice slides about building data centers in North Dakota, but can you actually do it?
Can you pour the concrete? Can you turn the servers on? This quarter proved they can.
And what about the bottom line? Adjusted EBITDA is positive, $20.2 million.
Why does that matter so much right now?
It matters because it proves the unit economics work. It means the core operations are actually making money. Before you even account for the massive construction costs, the machinery inside is profitable.
So they aren't bleeding cash on every unit of compute they sell. The model is viable.
The model is absolutely viable.
Okay, so the engine is running. But let's unpack this backlog number because I dropped it in the intro, and I think it's the safety net for this whole story. $16 billion.
It is a huge number.
Just to frame that, their market cap bounces around, what, 6 or 7 billion? So they have a backlog of contracted revenue that is more than double their current value.
Correct. And this isn't maybe money. This isn't a sales pipeline of people they hope to call. This is locked in. It creates a level of visibility you almost never see in tech.
15 years of revenue visibility.
15 years. And the anchor for that is this massive lease, a $5 billion 15-year lease with a major U.S. hyperscaler.
Now, we don't know the specific name, do we? It's still under wraps.
The specific name isn't public, but, you know, let's be real. When you talk about major U.S. hyperscalers, you're looking at a very short list.
The Microsoft, Amazon, Google tier of companies, maybe Meta.
Exactly. Whoever it is, it's a AAA credit tenant.
And having an anchor tenant like that locked in for 15 years, that just changes the nature of the company, doesn't it? It stops feeling like a wild tech startup.
That's the key insight. It sounds less like a tech company and more like a landlord.
A REIT, a real estate investment trust for AI.
That's it. They have the tenants locked in before the buildings are even finished.
It's like building a luxury apartment complex where every single unit is pre-leased for a decade before you even pour the foundation. You know exactly what your yield is going to be.
Exactly. But this begs the question, why them?
Right. If I am a trillion-dollar company, I have infinite cash. Why am I renting space from these guys in North Dakota instead of just building it myself?
That brings us to their moat. And it really comes down to two things, power and cooling.
North Dakota, that's not an accident.
No. They have secured exclusive access to low-cost power at their Polaris and Delta campuses.
And in the world of AI, power is the new oil. The grid is congested everywhere.
It is. You want 500 megawatts in Northern Virginia right now? Good luck, you're waiting 5 years. They found pockets of stranded power capacity gigawatts of it and locked it down.
Okay, so that's the power piece. But the cooling, this is where it gets really interesting from a tech perspective.
It really is. They have this proprietary liquid cooling technology.
Yeah, I was reading about this. The notes say it's 3,000 times more efficient than traditional air cooling. That sounds like marketing fluff. How is that physically possible?
It's not fluff, it's physics. Think about heat capacity. Water, or the fluid they use, absorbs heat way better than air does. A traditional data center is just a giant room with huge air conditioners.
And you're trying to cool the air to cool the metal. It's so inefficient.
Especially now. Modern AI chips, the Blackwells of the world, they run incredibly hot. They're basically little space heaters.
You can't just blow more air at them.
You hit a physical wall, you can't pack them tight enough. With liquid cooling, because you capture the heat so efficiently right at the source, you can pack everything much closer together.
So it's all about density, more compute power per square foot.
That's it. That 3000x stat refers to the heat transfer. By mastering this, they're one of the few places that can host the next generation of hardware efficiently.
Okay, so they have the power, the cooling, and management is targeting $1 billion in annual net operating income within 5 years. That's the blue sky scenario.
That's the target. If they hit that, the current stock price looks incredibly cheap. But there is one more piece of the bull case we have to touch on, the corporate maneuvering.
Chronoscale. This part confused me a bit, and I think it confuses a lot of investors.
You aren't alone. It's a bit of financial engineering, but it's smart. They are spinning off their cloud GPU business to merge with Exobionics.
Wait, hold on. Exobionics, the company that makes robotic exoskeletons, what do they have to do with cloud computing?
Functionally, nothing. Absolutely nothing.
So why the merge?
It's a vehicle, a reverse merger. It's a fast way to get Chronoscale public without a traditional IPO. Exo is already public, so by merging into it, the cloud business gets a ticker symbol immediately.
Okay, so Exo is just the shell. But why split the company up in the first place?
It goes back to your landlord analogy. Applied Digital wants to be the landlord, the infrastructure. That's a steady, predictable business. It trades on multiples of EBITDA, like real estate.
Lower risk, lower multiple?
Rent Chronoscale. Chronoscale will be the tenant, the compute business. They rent the servers, own the GPUs, sell the processing power. That's a cloud service provider.
And cloud businesses trade at much, much higher valuations.
Exactly. The service layer trades at revenue multiples that are way richer. By spinning it off, they hope to unlock that value. And Applied Digital still keeps roughly 97% ownership at first.
So it's a sum of the parts play. You're betting the two pieces will be valued higher separately than they are together.
That's the plan. It clarifies the business model for everyone.
Okay, that sounds perfect. $16 billion in backlog, revolutionary cooling, massive growth. But let's take a breath. I want to play devil's advocate here. Let's break that down even further and look at the risks.
We have to. If it was a sure thing, the stock wouldn't be bouncing around between $24 and $39.
It'd be at 100.
The bear case is very real, and it starts with a simple reality. Building gigawatt-scale data centers is incredibly, incredibly expensive.
We're talking billions of dollars up front.
Yes. And right now, their free cash flow is negative. They are spending money faster than they are making it. That cash goes out the door today, but the rent checks don't come in until the building is on.
That's a classic cash burn problem.
And to fund that burn, they have taken on debt. They are relying heavily on project financing. Now, they're backed by Macquarie, which is a huge infrastructure player, and that adds a ton of credibility.
Macquarie doesn't back losers, but it still means they're leveraged.
And if credit markets tighten or rates spike again, keeping the lights on while they build gets much, much harder. It's a race against time.
Let's talk about the tenants then, that customer concentration. The $5 billion lease is great, but isn't it also a massive risk?
It's a double-edged sword, for sure. When one customer is that big a chunk of your future, plus their relationship with CoreWeave, you are heavily reliant on just a few clients.
So if that hyperscaler pulls out, or if global AI spending just takes a nosedive,
then that $16 billion backlog isn't as solid as it looks on paper. Contracts are great, but they can be broken.
and you're left holding a lot of very expensive buildings in North Dakota.
Exactly.
Then there's the valuation. The stock trades at roughly 30 times sales.
That is priced for perfection. There is no room for error. When you are trading at 30 times sales, you cannot afford a construction delay.
So if the Delta Forge build-out gets delayed by 6 months because of some supply chain issue?
The stock could get crushed.
Yeah.
Investors are paying for that future growth today, any hiccup is a problem.
One more thing on the bear case. Insider selling. I saw about $13.25 million in selling recently. Is this a red flag, or are we reading too much into it?
We always have to be careful. People sell for all kinds of reasons, buying a house, taxes, but
What?
seeing insiders take over $13 million off the table when the stock is in the high 20s or 30s, it tells you something.
It tells you they don't think it's insanely undervalued right now.
That's how I read it. If you're a key executive and you truly believe this stock is going to $100 in 6 months, you generally don't sell a massive chunk at 30.
That's fair. If it was a guaranteed rocket ship, you'd hold on for dear life.
Right. They're happy to cash out some chips at these prices. It just signals that the current price isn't a massive bargain in their eyes.
So we have the bull case, we have the bear case. If I'm watching this stock, what are the specific triggers I need to look for in the next few weeks?
There are a few immediate catalysts. In February, we're expecting a site disclosure for that big Delta Forge hyperscaler deal.
Just telling us where they're building it. Why is that a catalyst?
Because it turns a press release into a construction site. It means permits are cleared, power is locked, it removes a layer of uncertainty.
Okay. And what about future growth?
Management has mentioned advanced discussions for 3 additional sites. We're talking another 900 megawatts of capacity.
900 megawatts, that basically doubles their current pipeline.
It is huge. If they confirm any of those deals turn discussions into contracts, that's a major trigger. It shows the pipeline isn't empty.
And then medium term, we have the spin-off closing.
Right. The Chronoscale merger is slated to close in the first half of this year. Getting that done and seeing how the market values the new entity will be a big driver.
And then fiscal Q3 earnings, probably in April.
That's the next truth test. Can they keep up that 250% growth? Was Q2 a fluke or the new normal?
I do want to touch on the price action. This stock is not for the faint of heart. It is extremely volatile.
Oh, yeah. It hit $39, then pulled all the way back to the $24, $28 range. It can swing 10% in a day on no news.
So you need a stomach for that turbulence. But analysts seem to think there is room to run, with price targets generally between $39 and $56.
The street believes if they execute, the stock should be significantly higher. It all comes back to execution.
So let's wrap this up with the lowdown. Applied Digital is a high-risk, high-reward play on the physical infrastructure of AI.
They aren't building the AI models themselves. They're building the factories where the AI lives.
They have the contracts, that massive $16 billion backlog. They have that liquid cooling, but they have to finish building those factories without running out of cash.
And they have to do it while navigating a volatile market and a very high valuation.
So here is the final provocation for you to think about. The question you have to answer is, are you buying a tech company or are you buying a specialized real estate developer? Because how you answer that determines if 30 times sales is cheap or expensive.
That is the million-dollar question. If it's tech, 30x might be a bargain. If it's real estate, it's astronomical.
Thanks for listening to the Easy Money Show. We'll see you on the next one.